Strip away one single business relationship from a major American airline, and the entire company would have lost money last year. That's not a hypothetical. According to a widely cited financial analysis of recent airline filings, if you remove loyalty program and credit card partnership revenue from the picture entirely, American Airlines' operating margin would have been negative. United's would have been negative. Southwest would have collapsed to nearly negative 20%. Not a single major U.S. carrier's actual flying business, on its own, reliably turns a profit in the way most people assume it does. Meanwhile, one single credit card partnership, Delta's arrangement with American Express, delivered over $8 billion in cash to the airline in a single year, a figure equal to roughly 14% of the airline's entire operating revenue and more than the airline's own adjusted operating income. American Airlines received over $6 billion from its own bank partners in that same year, a figure equal to roughly 4 times its adjusted operating income. Read that carefully. The money coming from banks is bigger than the money coming from operating the airline. This is not a video about which airline has the best legroom. This is a video about where the actual profit in commercial aviation comes from, and why the planes, the pilots, and the entire operation of flying you from one city to another may be, financially speaking, closer to a marketing expense than a profit center. Sit with the size of that gap for a moment. Delta's arrangement with a single credit card company generated more cash in a year than the entire airline's operating profit. That's not one revenue stream among several roughly equal ones. It's the largest single-line item propping up the entire enterprise. Sitting on top of a core flying business that, stripped of this money, would have lost money at nearly every major U.S. carrier in the same year. To understand how an industry built around flying came to depend on banks rather than airfare, you need to go back to the exact year the entire business model was forced to reinvent itself. For most of the 20th century, commercial aviation in the United States operated as a heavily regulated industry, with the federal government controlling which airlines could fly which routes and, crucially, what fares they were allowed to charge. This kept competition limited and margins relatively stable, but it also meant airlines competed almost entirely on service and schedule rather than price, because price itself was largely off the table as a competitive lever. That changed permanently with the Airline Deregulation Act of 1978, which removed federal control over domestic routes and fares and opened the industry to genuine price competition for the first time. The result was immediate and brutal. Fares fell, new low-cost entrants flooded into newly available routes, and legacy carriers found themselves competing on price against rivals with lower cost structures in an industry with enormous fixed costs, aircraft, fuel, airport gates, and unionized labor that don't shrink easily just because ticket prices are falling. Airlines needed a way to build customer loyalty that didn't depend entirely on winning a race to the bottom on fares, and in 1981, American Airlines found it. The airline launched AAdvantage, the first modern frequent flyer program, originally designed simply to reward repeat business travelers with free flights after enough miles flown. Competitors followed almost immediately, recognizing that a loyalty program could lock a business traveler, the airline's most valuable, least price-sensitive customer, into flying a specific carrier repeatedly, specifically to keep accumulating status and rewards, even when a competitor occasionally offered a cheaper fare on the same route. For roughly 2 decades, these programs functioned largely as intended, a customer retention tool, funded mostly by the marginal cost of occasionally giving away an empty seat that would otherwise have flown unsold. But everything changed once credit card companies entered the picture in a serious way, beginning in the 1990s and accelerating dramatically through the 2000s and 2010s. Banks realized that co-branded airline credit cards, cards that let a cardholder earn airline miles on everyday spending, not just on flights, were an extraordinarily effective way to acquire and retain affluent, high-spending customers, because travelers would organize an enormous share of their daily spending specifically around maximizing miles earned toward a future flight or upgrade. This created an entirely new financial relationship that had nothing to do with flying at all. Banks began paying airlines directly for the right to distribute miles to their cardholders at a scale that eventually dwarfed anything the airline could earn from giving away free tickets in the first place. The mileage program stopped being simply a marketing tool funded by unsold seats and became, in effect, a currency that airlines could manufacture and sell wholesale to banks, who then gave it away to cardholders as an incentive to spend more on their cards. By the time the COVID-19 pandemic devastated air travel demand in 2020, this shift had become undeniable in the starkest possible terms. Delta and United both used their loyalty programs as collateral to raise emergency financing, with independent valuations placing those programs' worth in the tens of billions of dollars, in some cases exceeding the airline's own market capitalization at the depths of the pandemic downturn. Investors and lenders alike were in effect valuing the loyalty program as a more reliable, more valuable asset than the fleet of airplanes and the routes those airplanes actually flew. It's worth sitting with how strange that moment actually was from a pure business history standpoint. Lenders extending emergency credit during an existential crisis for the airline industry weren't primarily securing that credit against aircraft, gates, or landing slots, the traditional hard assets of an airline's balance sheet. They were securing it against a database of customer names and a currency the airline had invented internally, because that currency, backed by a real ongoing relationship with a major bank, had proven itself to be a more dependable source of future cash flow than the actual planes sitting grounded on the tarmac during the worst demand collapse in the industry's history. That single financing decision, made under extreme duress, revealed more clearly than any earnings call ever had exactly where the real value in a modern airline was sitting. Which brings us to the question that actually explains why customers keep chasing miles and status with an intensity that often exceeds their actual enthusiasm for flying itself. If frequent flyer programs were purely rational financial tools, most travelers would calculate the actual cash value of a mile, compare it honestly against cheaper alternatives, and switch airlines constantly based on price alone. They don't, because four psychological forces keep travelers locked into a single airline's ecosystem regardless of what a purely rational fare comparison would recommend. 1. Status as identity. Elite status tiers, the various levels of loyalty membership that unlock priority boarding, lounge access, and upgrades, function as a form of professional and social identity for frequent business travelers in particular. Losing status at the end of a qualifying year doesn't just mean losing a practical travel benefit, it means a visible, comparative demotion, often in front of colleagues who track the same status tiers. This creates intense motivation to keep flying a specific airline, even when a competitor offers a meaningfully better fare, specifically to avoid the psychological sting of dropping down a tier. Airlines understand this well enough to design status thresholds with deliberate precision, often setting the qualifying bar just high enough that a traveler on the edge feels compelled to book one additional trip specifically to protect status they've already spent a year accumulating, regardless of whether that final trip is otherwise necessary. 2. The sunk miles fallacy. Once a traveler has accumulated a meaningful balance of miles with one airline, switching to a competitor means abandoning that balance or accepting an unfavorable conversion rate to transfer it elsewhere. This creates a powerful lock, in effect structurally similar to the sunk cost dynamics seen in other loyalty-driven industries. The miles already earned function as a kind of gravitational pull, keeping the traveler flying the same airline specifically to avoid stranding the value they've already accumulated, even when a rational, forward-looking comparison of the current trip alone would favor a different carrier. Airlines have reinforced this dynamic in recent years by making mileage earning rates on non-cardholders progressively less generous, which quietly raises the cost of ever starting fresh with a competitor's program from scratch. 3. The everyday spending reframe. Co-branded credit cards have successfully reframed an enormous share of ordinary daily spending, groceries, gas, streaming subscriptions, and utility bills as an opportunity to earn progress toward a future flight or upgrade. This transforms mundane, otherwise emotionally neutral purchases into small, repeated wins toward an aspirational reward, similar to the variable reward psychology that drives engagement in other industries. A cardholder isn't just buying groceries. They're one step closer to business class to Tokyo, and that reframing measurably changes which credit card gets pulled out of the wallet at checkout, regardless of whether a cashback alternative might actually deliver more real financial value. 4. The illusion of a free upgrade. Airlines have become extremely skilled at making elite perks, free check bags, complimentary upgrades, expedited security, feel like generous gifts bestowed on loyal customers rather than what they actually are, carefully calculated incentives designed to keep a specific high-value customer segment locked into a specific ecosystem. The emotional satisfaction of receiving a free upgrade reinforces brand loyalty far more effectively than an equivalent cash discount would, because a discount feels transactional while an upgrade feels like recognition and status, even though both ultimately cost the airline a similar amount in foregone revenue. Put these four forces together, and you get an industry where customer loyalty is engineered to persist independent of whether the underlying flight experience or price is actually competitive. Because the psychological cost of switching, built around status, sunk miles, everyday spending habits, and manufactured generosity, is specifically designed to exceed the rational financial benefit of comparison shopping most travelers would otherwise engage in. It's worth appreciating how these four forces reinforce each other rather than operating in isolation. Status anxiety from level 1 motivates a traveler to concentrate spending with one airline specifically to hit the next qualifying threshold. That concentrated spending accumulates into the sunk mileage balance from lever 2, which itself becomes a reason to keep booking the same airline in the future. Meanwhile, the everyday spending reframe from lever 3 is quietly pulling in credit card purchases that have nothing to do with travel at all, further inflating the mileage balance and deepening the sunk cost lock-in. And every free upgrade or waived bag fee from level 4 arrives at precisely the moment loyalty might otherwise waver, resetting the emotional goodwill that keeps the entire cycle running. A traveler would need to consciously override all four mechanisms simultaneously to make a genuinely rational, price-only comparison between airlines, which is precisely why so few travelers, even sophisticated ones who understand these mechanisms intellectually, actually do it consistently. Let's open the actual books, because the psychology in part 2 only functions because of what these numbers actually reveal. Start with the core flying business. Commercial airlines operate on notoriously thin margins even in good years, squeezed between volatile fuel costs, heavily unionized labor costs, and a customer base trained by decades of price comparison tools to treat airfare as a pure commodity. Recent industry analysis suggests that without loyalty and credit card partnership revenue, American Airlines would have posted a meaningfully negative operating margin, United would have been solidly negative as well, and Southwest's operating margin would have collapsed to nearly negative 20%. The actual business of flying planes, in other words, is frequently unprofitable on its own at several of the largest carriers in the country. Now look at what's actually propping that up. Delta received over $8 billion in cash from American Express in a single recent year, roughly 14% of the airline's total adjusted operating revenue and about 1.4 times its entire adjusted operating income, meaning the credit card partnership alone generated more cash than the airline's core operations produced in profit. Delta has publicly stated it's targeting as much as $10 billion annually from this single partnership. American Airlines collected over $6 billion from its own bank and co-brand partners in the same period, a figure representing roughly 4 times its adjusted operating income. At Alaska Airlines, loyalty revenue alone made up around 16% of total company revenue. This is why independent valuations place the major U.S. airline loyalty programs in the tens of billions of dollars each. Delta's SkyMiles program has been valued at roughly $28 billion, American's AAdvantage at around $24 billion, and United's Mileage Plus near $22 billion, figures that, at various points during the pandemic downturn, genuinely exceeded the entire airline's own market capitalization. When a company's frequent flyer program is worth more, on paper, than the company itself, including its planes, gates, and routes, the loyalty program has stopped being a marketing appendage and become the actual core asset. The mechanism generating all of this cash is straightforward once you see it clearly. Airlines sell miles wholesale to banks at a price per mile that the bank then effectively gives away to cardholders as spending incentives. The bank profits because co-branded cardholders tend to be higher spending, lower default customers who generate substantial interchange and interest revenue. The airline profits because it's collecting real cash for miles today while only being obligated to provide the actual flight, seat, or upgrade at some uncertain point in the future, and airlines have become increasingly aggressive about making those future redemptions harder to earn, tightening mileage earning rates on non-cardholders and raising elite status thresholds. Specifically to preserve the profitability of a currency they're now manufacturing and selling at industrial scale. There's a subtle accounting dimension worth understanding here too. Airlines don't recognize all of this cash as revenue the instant it arrives. A portion gets deferred on the balance sheet, recognized only as miles are actually redeemed for flights, while another portion tied to the marketing value of the partnership gets recognized immediately. This deferred revenue structure means an airline is, in effect, sitting on a growing liability representing millions of future flights it's obligated to eventually provide, funded by cash it already collected, and in many cases, already spent. As long as new miles keep getting sold faster than old miles get redeemed, this functions as a reliable, ever-growing float of cash on hand. A dynamic not unlike how an insurance company profits from holding premiums before eventually paying out claims. Except here, the claims are seats on airplanes that cost the airline only a marginal amount to provide compared to the cash already collected for. The mile itself. None of this makes the airline a villain or the miles a scam. It makes modern commercial aviation an industry that has quietly restructured itself so that the actual transportation of passengers functions closer to a customer acquisition and brand engagement exercise for a much larger, much more profitable financial services relationship happening one layer up, between the airline and the banks paying it billions of dollars a year for the right to hand out its currency. So where does this actually go from here? The dependency on bank partnerships is deepening rather than easing. Airlines continue renegotiating and expanding co-brand agreements. American's newly expanded partnership with Citi is explicitly aimed at closing the profitability gap with Delta and United, both of whom already generate a larger share of income from their bank relationships. Expect continued redesign of mileage earning structures that reward credit card spending more heavily than actual flying. Continued tightening of elite status thresholds, and continued expansion of premium credit products carrying higher annual fees, all specifically engineered to keep this now dominant revenue stream growing. Industry observers have begun describing major carriers as lifestyle brands as much as transportation companies, a framing that would have sounded absurd a generation ago and now shows up in serious industry analysis without irony. This dependency also creates a new category of risk the industry hasn't faced before. Airline executives have publicly acknowledged that loyalty revenue is increasingly exposed to decisions entirely outside their own control. Regulatory proposals to cap credit card interest rates, for instance, would squeeze bank profitability on these co-branded products and could ripple directly into what banks are willing to pay airlines for miles. Since the entire arrangement depends on the bank's own underlying card economics remaining healthy, an airline that has restructured its profitability around a financial services relationship is now, in a very real sense, exposed to banking regulation and credit market conditions in a way that has nothing to do with jet fuel prices or passenger demand at all. Airlines with cardholders who carry stronger credit profiles and lower default rates may prove more insulated from this risk than competitors whose card portfolios skew toward more marginal borrowers, adding yet another dimension of competitive differentiation that has nothing to do with the quality of anyone's actual flight experience. At the same time, the flying business itself hasn't become irrelevant. It remains the mechanism that generates the underlying customer relationship banks are paying to access, and the aircraft, routes, and schedules airlines operate still matter enormously to which bank wants to partner with which carrier in the first place. A bank paying billions for the right to distribute an airline's miles is ultimately betting that people will keep wanting to fly that specific airline enough to make its currency valuable, which means the flying business still functions as the foundation the entire financial structure sits on top of, even if it no longer functions as the primary profit engine in its own right. None of this means your next flight is secretly worthless to the airline operating it. It means the frequent flyer card in your wallet and the bank quietly paying billions for the right to put miles on it may matter more to that airline's bottom line than the actual seat you're sitting in, a fact almost entirely invisible from economy class and central to nearly everything happening in the boardroom above it.